Hello and welcome everyone. Thank you for signing in for our weekly meeting here. Let me close this out. Still have a few people joining here. So what we're going to do today, we're going to cover, we've been kind of moving these to like 1 hour. So what we're going to do is, go through the market update. There's one feature I just wanted to make sure you guys were aware of, for the creating a stock list based off of ETFs. And then Shawn's going to go through some earnings information, trades. Looks like some people are having problems getting in. Okay, so as far as the market update, we've been kind of harping on this for quite a while, almost like a broken record at this point. Sorry, I'm still getting joins here. Obviously still near, our all-time highs for state one percentages. So we're still right up there. And overall, we're at 83% overall. That's going to pull up, the chart here. So, the high that we had back in 2010 was 72.74. So we're currently, we eclipsed that slightly, 73.1. And, it turned back to 72 yesterday. So, so definitely overall, very overbought market with great, breadth. You can see 72% are in state one. So let's go back, and I just wanted to review. This is our current SPX state modeling. It did, the average move and then kind of popped up above the 3, and then, once it got there, it tested that 3 as support. And we talk a lot about these being support and resistance, with target 3 being our most important resistance, because, the average move, 4.89 is going to be right in between 2 and 3. So this will be our strongest resistance. That's target 3. And our big support is entry, and then, our stop loss. So once it popped above and held that, the target 3 resistance, that turned into support here, and, we kept running here. So, if we go back in time, and this is back, April 26, like right around here is when, we got that 72.7 back in 2010. And almost immediately, started turning down. And you can see at that point that target 3 had turned into support. And once it crossed below there, the next day, once it crossed below that support, it transitioned into state 2. Sorry, so that was the next day. It turned into state 2. And I pulled up a chart here of just, what happened after that. Here's April 26th when we hit that high. Definitely some volatility coming in. Now, I'm not saying, today's date is going to be an exact mirror of this, but, this is the one data point that we have to go off of. And you can see from this, that peak, which, we're at the same, right around the same level for those state ones, up until, this market was, pretty down, and then going into August, it finally kind of turned around September timeframe. So that was a long, that would, be a correction to the market. I'm not saying it's going to exactly mirror everything here, but based off of those kind of indications, the one data point that we have that's what looks like set up just because of how overbought the market was then and how it correlates to now. So that's one data point. Sorry, we keep getting joins here. So that's our only data point as far as that market pulse that we can go off of right now. So whether it matches perfectly or may take a bit longer, I think most people will agree that we're due for a pullback, maybe even a correction in the market, but hold on. I have to mute people when they come in. So that's kind of where it sits as far as market pulse. Now, what I also wanted to pull up, and you can go back in time, obviously, on the time machines here, and you can kind of see how this all played out. If you can just move forward and pull up the charts and see what happened as far as the different state transitions. You can also pull that up, on this chart by just putting in the state modeling symbol indicators, and then we can populate those. So you can see those, like the history of how things turn. But, like I said before, that target 3 is always like a critical price. And those are, developed using machine learning. And, there's a lot of things that go into it, including like Fibonacci type stuff. So, so those are very important and key levels that you want to keep an eye on. So here, April 26, a couple days, big down days, 1 into 2. You probably got to bounce off that target. Let's see if it. Yeah, so it bounced. That's our normal trade. That we look for a lot of studies and things like that. It hits target 3 and it'll bounce for a quick profit. So it actually did that right there and then turned back down. So so when you pull up, you can see did that bounce off target 3, which again very important levels in this system. And then, turned around, 1 into 4. It looks like it eventually hit, and well beyond target 3 for state 4. And we can pull up that also June 6th. 7th. I think that's right. So this is state modeling. So when we pull that up, May, June, oh, sorry, it's July 6th. Just kind of want to do the walk through and see how this one played out. Okay, so we went down, and the stop losses, provided, the downside support here, crossed above and then turned down, and eventually, got below that target 3, but not much more beyond that. So, when we talk about, just kind of mapping these indices to figure out, where things can go, you can do this all with individual symbols too. Obviously we kind of preach that you want to use the markets to get the general direction, do the analysis on the markets, but you can also do these on individual symbols. So 4 was pretty much the bottom. It did go to 8, and that wasn't. It went to 8 twice here. So, but that was kind of the initial swoop down, and the bottom of that move was about 1,000, about 200 points or so. And I know we kind of covered that a little. I just want to go to, last week, I just want to go in a little more detail on that. The other thing I did want to, kind of correlate with things that we've tracked in the past So this is the current Russell, off in the stratosphere. So this reminded me of back in 2018, where SPX, NDX, they all went up in the stratosphere like this. So when it turned over, it's hard to say. You could have been bearish, starting here, and you got killed. So once things turn, we know these things move very quickly. So what I wanted to do was pull up a chart to show you how important, that target 3 is. And it'll make sense there in a minute. Sorry, apologize, it's loading a little slow right now. I think I got too many tabs up. So that you can see this thing go up in the stratosphere, right? And then if we look at that target 3, which is the only level of support that we have in modeling at this point is at 2603. And you can see once this thing turned over, within a matter of days, it crossed below right there. The low was 2593. So it came back, in a matter of, like a little more than a week, all the way down, negating this whole profit, that took, months to accumulate. Sorry, mute them. Okay. So that's, I've talked about this before, and I've shown this kind of chart in the past, where things typically come back down to that target 3. Now, current day for the Russell, that's 1688. Am I guaranteeing it'll go down there? And no, but it's happened enough that I wanted to show you kind of how those things work out in the past. And there's multiple examples of this. I'm sure there's some that didn't do that exact level of move, but you can see this kind of wanted to show you an example of what I was talking about and just highlight how critical these support and resistance levels are in the system. And let's see what else. Let me pull up. So we kind of looked at NDX and the Russell. Got too many things open. Well, that's loading. Is there any questions on those from anyone? You can feel free to unmute yourself and chime in. No?
Josh, it's Lee.
Hey, Lee.
So it looks like when this thing turns, I think you were around April or May, and then in late June, early July, it seemed to bottom.
Yeah.
So we're saying it takes, and there's some up and down in there, that it's going to take 60 days to hit the bottom.
Right.
And it's probably a longer climb up. So if I have trades on, it's a good thing to make a decision to go on and take a loss if I'm in a loss position before it loses more or it's a total loss.
Well, I mean, I'm not saying it's going to turn over immediately. We've been kind of preaching or, telling you guys, since this thing is so overbought, for like the last month or so, it's just, be careful. We talk about like, hedging or things like that. This would, over the last month, this would be where you would want, to have those kind of plays, to back you up, in case things do turn over. Obviously, there's a lot of different ways you can hedge. There's, cheaper ways and, expensive ways. You can just buy straight puts. There's, you can do like butterfly type trades. So there's a lot that you can do, but at this point, it's just like the probabilities are really, is where things are, concerning. Can it go up? Yeah, obviously, it can keep creeping up or whatever. But probability wise, I mean, you're kind of betting against the house here. But trying to pick that perfect top or whatnot, it's nearly impossible, except for blind luck. But I think it's just a matter of if you think about like Sudhir last earnings cycle, he's coming into the election with so much uncertainty, and he just took a break for 2 weeks. He pulled off his trades and took a break. So, there's nothing wrong with that with,
Josh,
yeah, sorry.
it's I've probably put on 30 bullish pre-runners. And up through last week, they were beautifully profitable. The last week has obviously not been nearly that good, but
Right.
so sitting here looking at 15 current losers.
Mm-hmm.
The theory of a bullish pre-runner is that it's an individual stock issue.
Right.
Affected by the overall market, of course, but it's still an individual stock issue.
Right.
My point is, I'm going to see this through.
Yeah.
I'm just, particularly because it's an earnings strategy affected by the market, but controlled more by the fundamentals of the individual issue.
Right.
I'm curious to know what others who might be similarly involved in bullish pre-runners are experiencing.
Yeah. Well, before that, we've been tracking these we created and tracked them for years. I would say the one quarter where you didn't make money was when in the fall when they did that temper tantrum, and they raised the rates real fast, and the whole market just pulled everything down. That quarter is the only thing I think we really have to watch out for. Hold on. That you have to watch out for in this strategy is, big, because if the whole market rolls over, it's going to pull everything with it. Moves like that, moves like that, beginning January, beginning of 18, where, everything was so overbought and, everything rolled down. It didn't even matter at that point. So that's all I think, I'm trying to guard people against as far as the strategies. Luckily the Corona was like right before earnings, last year. So it actually worked really well for, for all those trades. So, that's the biggest thing I think you just have to guard against as far as, that type of strategy. You want to play this systematically, but, I think, you still want to have, just be careful of a big market move because, these will work as long as, that's the only instance I have seen where this hasn't, had good win rates and, made money. But I'll open up to other people, for their, how they're doing right now.
Well, this is Dave. I got a comment, maybe a counterpoint to Bob's thought that the earnings season is a reflection of the value of a company. I would say that's probably not the case since like last March when all the companies quit giving forward guidance. And yet there would be all the analysts come out with opinions on, because they got to say something, right? Based upon what they think the market will look like the market for that underlying will look like in the next, 6 months, a year, 2 months, whatever. Right? So there are always, opinions on the future, not really what the stock has done. And I can't say that anything that I'm looking at now is a reflection of the true underlying value of a company when it doesn't give guidance and it reacts based upon sentiment. And that's kind of where the sentiment trade is now today. It's like, do you believe in the market recovering? The market, I used the term that doesn't really exist there, that markets in the future will be more like they were before the pandemic 6 months from now or not. It's kind of like you're betting everything against where we think things will come out of the COVID-19 crisis and how quickly that may or may not happen. That's my opinion on anything. Let's say Microsoft, it just announced earnings, right? Did great because all the cloud, right? Well, nobody knows what, are they selling more Microsoft Word and Excel and none of that. They're selling cloud stuff. So it's Peloton is like take some of the work at home, Zoom and Peloton, for example. They're way up because the pandemic. They're not up because of their intrinsic value or their value today. It's what their multiple might be worth 6 months from now is kind of where you have to think about individual stocks. So I think the earnings trades, like the flies, have a tendency to work out when there is no unknown, because then nobody knows what to do, and it's like, well, we're not going to move the stock too much because we don't know what could happen. So it's liable to move less. That was the first quarter back in a year ago when all those trades worked out pretty well because there wasn't very little movement in some of the stocks. Because nobody knew what to happen. Now everybody's trying to guess what's going to happen based upon what they think the outcome might be for the pandemic. With regard to the space that the individual stock exists in that you're thinking about trading or what. So I don't know. My opinion today is I look at some of the bellwethers. I'm using this earnings cycle to see who is going to actually give forward guidance that didn't give it in the past and how well those stocks work out. For example, Apple has not given forward guidance since last March. We'll see what they do this quarter. But the big guys, the ones that the popular stocks are the ones that people have a hard time identifying with. Well, how does Amazon make money? Well, they sell stuff. They deliver stuff and you pay a fee for Amazon Prime. Now, they're certainly selling everything more today, but are they making money doing it this year compared to last year? We'll see. We'll see that in like a week. So I look at some of the big players in the individual areas to see how they're reacting, especially this year compared to a year ago when they didn't say anything. So I'm hoping to hear more. I listened to several conference calls already, and they're starting to give quarter guidance ahead, but not full year guidance too much farther ahead. So that's one statistic I wish I could find somewhere globally as to how many stocks in the S&P or the Russell or whatever are actually giving forward guidance. I think that helps people when you don't have that. It's just the opinions of different opinion people offering their opinions, like I'm doing right now. So it's like you can't take anything what I'm saying with too much of a grain of salt because it's just what I think.
Yeah. Well, like I said, Bob, the pre-runners, I think you just have to guard against, a big market rollover, which doesn't happen very often, obviously. As far as like the vol crush trades, I don't even no, you have good risk to reward. I mean, that's just like a systematic trading strategy that I think for the most part you can, even if you have a big down day, a lot of it usually doesn't move straight down. So, you may have a few days like that where it moves straight down where you could get hit, but I think most of those you want to just, play systematically. Does anyone else have bullish pre-runner comments before we move on here? We already morphed into earnings, which is Shawn.
Yeah,
Anyone?
Josh, Dan Arnold here. Yeah, I did some of the bullish pre-runners and I just placed those probably about a week ago, and they're not doing well at all. And I think it's just because right now there's seems to be a drag, or at least a pending drag on the market. One of the thoughts I had, did you go over one time about to show unusual option activity on Delphian? Is there a way to track like if there's unusual put volume?
Yeah. We have that there's a screener under options, and that'd probably be a good thing to cover. In our next meeting, we can go through that. We have your options. I think, which one is it, Shawn? Is it the activity? The names, we're renaming some of these, so it's a lot more intuitive. But yeah, the options activity, you can go through and change, look for all those type of things. So this is
Okay.
yeah. So so that's where it's at.
Yeah, because I know yesterday there was seemed like there was what do you call it, unusual option put option activity on yesterday. And I went out on the futures on FinViz, and I look at insider selling, and there's been a lot of insider selling. I mean, huge money,
Yeah.
Well,
we have those stats in the stock overview. You can pull that up too if you want. So.
Oh, okay.
Yeah. Okay. Okay. Thanks, Dan.
Thank you.
Okay, last chance for comments from me before Shawn gets going here. Any other questions about the market, things like that? All right, Shawn, you ready?
Yeah, I'm here.
All right.
Yeah, I'll share my screen. How's everybody doing? Now let me put this up here. And so just, yeah, I'm going to show some of the stuff on, the vol crush. I have a good trade example that I want to kind of go over using the vol crush trade and related to the earnings. But, similar to what Josh was going over, with Bob and with the other people, it's, the trades themselves are standalone for the earnings trades, and those bullish pre-runners are, in my mind, standalone events coming into, an earnings announcement from a company, which Walmart is going to be, potentially vastly different from an earnings announcement via Tesla, still surrounding kind of the market as a whole is kind of pushing those earnings for those companies, but needless to say, they should be independent. But, that being said, I think to test further within Delphian and use the platform to, a percentage of its capabilities is prudent to try to find out, okay, based on these bullish pre-runners, let me take into some of this market environment or this market sentiment or this market activity into place and see if I can match a signal up and compare those two. How do those bullish pre-runners or bearish pre-runners react when we have these certain market environments? And obviously, as everybody knows, COVID and the change of the presidency and everything that we have going on is, different, versus anything we've ever experienced, or at least I've ever experienced in the past, based on what the pressure it is on the market. So we have an anomaly there that's going to be quite different, but I think you can still try to find some really good indicators to help kind of solidify some of your ideas and help you make, I don't want to say better investment decisions, but make investment decisions that might be, better based on the current time that we're in. That being said, barring, some of the results we've had over the past, couple of weeks with these trades, those bullish pre-runners are still working fairly well. We do get some of these, I think, with that volatility possibly, coming out of some of these options, that's pulling those option prices down. So we're seeing a little more decrease in the value of those options in my mind. Others could disagree. but it does take away from some of that potential profitability. But as we've seen on some of those other ones, like Avis, MasterCard, definitely not. But some of those can jump pretty quickly, and when they do, I think you're able to get that profit out of that trade as long as you have that order standing. And those are the ones that we might want to test a little bit further, based on, do they go into those other categories to possibly help, make money from the trade if it goes into a bullish runner strategy, or, these different earnings that we might be able to have in place. So I'm still tracking all those in the virtual portfolio, trying to set them all up. It's definitely more of an issue with a lot more of the ones that we have, but I just want to kind of, mention my thoughts on that real quickly. We've talked about the vol crush trades. I have a great example from last week, Netflix. I don't know if anybody traded that one live on the vol crush strategy, but Netflix had earnings come out last Tuesday on the 19th after the market closes. So I want to go over that trade and show you how I'm tracking it in the virtual portfolio and try to give you some, comparison and contrasting issues of what you might want to do when you're looking at a vol crush trade like that. Everyone knows, or at least I hope you know, that if you want to get information on those earnings trades, the vol crush trade specifically, and how it's set up, how the trade's designed, what we're looking to do, you can always come in here to our resources page on our website, and you can go down to resources and you can look at this view section here, trade on earnings. And this will basically give you the documentation and kind of give you a brief synopsis or description of all of the different earning strategies that we have. I know I've shown this before, we've talked about this before, but I want everybody to still use this as a resource, if you have any questions. We've put out those webinars too on the website or on YouTube, so please check those out. If you ever come into question of, how the strategy is working, or what should I do, or try to get a good idea or grip on the actual strategy itself. So, excuse me. So that's the resources page, and then obviously the YouTube channel. So what I did was, again, earnings for Netflix had come out after market close on the 19th. So what I'm going to do is I'm going to use the time machine here and go back to the 19th, like it's the day of the 19th. So as you know, with the vol crush, if the earnings comes out after market closes on the 19th, we want to try to get into that vol crush trade as near as possible to the market close, or as near as possible to the earnings announcement, because that's really what we're trying to trade, is that earnings announcement and that volatility crush on those options, on those option prices. So, if I get into the trade on the morning of the 19th with the earnings announcement in the afternoon after the close, Netflix, Amazon, Tesla, those stocks can move pretty big intraday. So if Netflix moves 20 or 30 bucks intraday, that's going to vastly skew the straddle that I should be selling as part of my vol crush trade, as part of my iron butterfly trade. So we want to make sure we're getting as near to the close as we can, but not obviously too close to where we're going to get concerned about getting a fill or potentially maybe put in a trading error. So trying to push that 3:30 in the afternoon before the earnings announcement is probably going to be the best practice if you can do that. And then that's obviously going to get you as close to the market price on the close as well. Obviously the market, Netflix can move dramatically from the last 10 minutes of trading as well, but you can only do what you can do, right? So try to work within those limits and see if you can push it towards the later part of the day when you have those after the market releases. So what I did was I went into my virtual portfolio. So I'm on the 19th again, which is the day of the announcement after market close. If I go into my virtual portfolio under organizer, virtual portfolio, what I can do is I actually already added this in there, but let me just show you the way that you would want to do it, so you could try to replicate this as well. I'm going to click add new, and this is going to add a new virtual portfolio. I'm going to say Netflix, and I'll do earnings Q4 2020 vol crush. Now you can obviously put in a description in here if you wanted to do it for only Netflix or other different symbols. You could do that. You could say Q4 2020. Put in the dollar amount.
Hey, Shawn, your voice is kind of going in and out.
Oh, is it? Sorry. Is it better now?
No.
Oh.
Yeah.
No?
Yeah.
Okay, sorry. Let me turn the volume. I'm using the laptop, so I apologize if getting animated. You can't see it, obviously.
Yeah, I can't hear you, Shawn.
You can hear me?
Barely.
Let me see if I can somehow plug in and see if you can hear me on the speaker. Hold on 1 second. Is this better now?
Try again.
Is it better now? Still vague?
A little better.
A little better. I got my headphones in now.
Sounds real low.
Real
Yeah, it's
low.
just low.
Still low now?
Yeah.
Still low. Let me see.
Yeah, we can't hear you.
I can't hear him.
I can try to call in. If you give me a second, I'll call in.
Yeah, just call in. Yeah, sorry, everyone. It'll be a minute.
Hello. Can you hear me now? Better?
Sure.
Hey, Josh.
Hey, Josh.
You're on double talk. Let me, all right, there you go.
Can you hear me, Josh?
Yeah, loud and clear.
Okay, cool. All right. So yeah, I just had my phone. Sorry about that, guys. So yeah, I'll just give it a name, for my virtual portfolio, a description. You can, use the description as you see fit. Typically, I just put an amount in of $100,000. You can make that adjustment, as you see fit as well. I usually do these positions as 25 across the board. Again, this is getting more into the depth of a virtual portfolio than I like to do. So I typically just kind of put those in standard, and then I allow to exceed the amount and the risk. But these are typically the main thing are the names and the amount that I would really, want you to focus on. If I hit create, it's going to create that virtual portfolio for me right here at the top, the Netflix earnings. Now what I can do is I can actually click on that portfolio. You can see there's no positions in the actual portfolio. And again, I'm still on January 19th. So if I wanted to add a position in to track it, I'll click add a position. I'll type in Netflix. I'm going to select my strategy, which is going to be an iron butterfly. And then what we can do is, so as we know, the earnings announcement is going to be on the 19th. So we have an option essentially, or we have a choice that we can make. So we can either use the expiration for the 22nd or the expirations for the 29th. From our results and kind of what we've discussed over the past couple months, giving ourselves that extra time to run through this week and then that next week for the expiration, gives us a little bit better of a probability if, the market actually moves against us initially, and then it's potentially that it could come back and help us out. And if it does, having that extra time on that trade just gives us the ability to kind of navigate a little bit easier. But what I'm going to do is I'm actually going to show you both expirations and let you kind of visually see the difference between the two. So first I'm going to put in the expirations for the 22nd, and then I'll do the 29th after that. So looking at January 22nd, and if I look at the market at being around 501 on the close. Now, when I did the trade myself, the market was a little bit higher. Netflix was around 503, 504. So I actually did a 505 spread. A 505 straddle. So I sold the 505 call that was at the money for January 22nd expiration, and I sold the 505 put for the January 22nd expiration as well. So I sold the straddle, and I was able to collect the credit for doing that of roughly, 31, 32 bucks or so. Now, as we know, the value of those options, the put and the call that's at the money, is going to be the expected move for that particular stock based on that earnings announcement for this option expiration. So those are going to be used as the value of our wings. And again, use those resources page that we have available if you want further explanation of that. So, when I actually select my call and I select my put that's going to offer that protection, I want to be able to find one that's roughly that expected move in value, and that gives me that protection. So, for this one, like I said, it was around 31, 32. There weren't many options available above and below that expiration right at the value of that expected move. So I ended up doing a 540. So I did a 545, I think, 545. And then I actually did a 465. And so with this layout of this trade that I ended up putting in the virtual portfolio, you can see that my risk to reward isn't exactly what we've been talking about. It's not a 2-to-1 risk to reward, but it is taking that expected move by selling that straddle. It still is giving me a pretty good profit of credit of $2,500, and my risk is $1,500. So again, we know coming up with that risk, the profit versus the risk, is I'm taking the credit that I receive and I'm subtracting it from the difference between the spread. So I'm selling. So if you want to look at this as just one spread here, I'm selling a call spread, and I'm selling that call spread, and the max risk on that call spread is 40 points or $4,000. And I'm getting a $2,500 credit. So therefore, theoretically, my max risk is going to be the $1,500.
Mm-hmm.
Now, it also shows me now that my break even. So I can look at my break even prices below, and it's telling me my break even is 480 on the downside and 530 on the upside. So as the market moves away from 505 and starts moving up towards 550 or 530 or even higher, I basically have a credit. And as the market moves up $1 from 505, I'm giving back some of that credit that I've already received. And as the market hits 530, that's my break even. So anything above 530, I'm losing $100 for every dollar that it moves, all the way up to my 545 call, which is essentially my hedge or my protection on the upside. I know we've talked about this before, but I want to just get a clarification, just make sure everybody kind of understands the scenario and the setup of that trade. Do I have any questions thus far?
I was just curious, when you were picking your wings, were they inside or outside of the
expected move?
Yeah.
we tested as being one strike above the call side and one strike below the put side's expected move. So the next strike above or below it.
Okay, so you went outside basically. When in doubt, just err to the outside is kind of like the rule of thumb.
Right,
Okay.
right. And as we've talked about, before, the credit that I receive is $2,500. So I'm using the straddle price as my expected move and to set up the wings of the put and the call on the outside. But if my expected move is around $32, the $2,500 credit isn't completely covering that expected move. So, to be able to do that, you really have to push your strikes out quite a bit further. And then I believe that drops your risk to reward, ratio substantially. So, that's something that we could test to see overall, does that strategy make more sense to try to capture the entire expected move within the credit that you receive, but it's pretty difficult to do so.
Hey, Shawn.
Yes.
Show that risk graph, would you? We can't.
Oh, yes, sir. Yeah. Yes, sorry.
Got it. Okay, thank you.
No problem. So yeah, as Bob's mentioning there, here's our risk graph. As we're coming down in price in Netflix, we're starting to come to our break even, which is here at this level. Oh, sorry, it's not pulling it right. Right here at the green, where the green meets the red at 0, and then we're losing money. And you can see the curve flattens out because we have that put in there for protection. So Netflix could go to 0, and our max loss is still only going to be $1,500 on the trade. Same on the upside. Netflix could go up to 900 and change, and we're still going to be losing our $1,500 max risk because we have that call there for protection. So,
you took
excuse me. Go ahead.
Trade, did you do this in TOS?
I did do this one in TOS, yes.
Did it let you take all 4 legs off as a single exit, or did you have to work it through leg by leg?
I do it as a complete exit of all 4 legs.
Okay, got it.
But you
So
can
yeah,
do
when I
either. You can do both.
yeah, you can do both, and this is something that's pretty important too, right? Not necessarily for you, Bob, but for other people as well. But you can do them individually. But when you do that, you have to be very systematic and make sure you've practiced this on paper, because you could really be exposing yourself to a huge amount of risk depending on how you're doing this. If you have all 4 legs in on separate orders, you know, you're going to get filled on one as possibly the other one is kind of running away from you. And if that's the case on some of the ones that you're short, it could cause a huge problem. And the biggest problem would be your $1,500 risk turning into $4,000. And not that a lot of people don't understand that going in, but I've done it before when I traded commodities. And if you're in the heat of the moment trying to manage out of a trade like that individually, things can get chaotic pretty quickly. And now you're paying extra money for things that should have never happened. So that loss is just compounded. So not only does it hurt that you've taken a loss on the trade, now you've taken more of a loss on the trade than was initial, given here. And since you're, basically running on this level to where you couldn't really think all that properly, for the lack of a better word, now you just made yourself even more frustrated. So I really advise to get out of these things as a whole, all 4 legs together. Some of them have a little more difficult time depending, because obviously if the stock moves up dramatically, the value of the put side is going to be almost negligible. So, whoever's taking the opposite side of that trade might not want to do those, might not want to take those puts. But, to be on the safe side, it's best to manage out, as a whole if you can. If you can't, just make sure you have your, the priorities written down on a piece of paper and just analyze everything before you start making those, in-trade adjustments and kind of get caught. Is that fair?
Hey, Shawn,
All right. Yes.
if this was your trade, what day and what time did you exit?
So this trade, and I'll go through that too in a second as well and kind of explain that to everybody, just if you give me like 2 minutes or so.
Sure.
So, yep. So I'm going to put this trade on now. So I'll hit create. That adds the trade. So that added the trade into my virtual portfolio for 122. Now, what I'm going to do is I'm actually going to add the one for the next expiration as well. So the next expiration will be 129. Gives me another essentially 5 trading days on the trade. So let me go in here, add position. Netflix, I'm typing one-handed, so sorry. Netflix, I'm going to do the butterfly. I'm going to select the 129. I'm going to do the same strikes, 505, 545, and then 3. Oh, sorry, hold on. Oh, sorry. Sorry about that. I did that, Josh, sorry. And then I'm going to do 465. All right, so basically this one I'm looking at roughly 37 and change, almost $38 as a credit. Now the reason my credit on my straddle is more for this particular straddle is obviously because I'm going out further in time. I'm doing the 29th expiration versus the 22nd. So I have 5 more days of these options that have value, so therefore they're giving me more of a credit for this particular straddle. So now we can see on this trade, my risk is going to be 1,300. My credit I received is 2,600. So roughly that 2-to-1 that we talk about, that is probably optimal, in our opinion, as we've done this research, as going to be the better of the trade, because not only do I have more time, but basically I'm getting that 2-to-1 risk to reward. So that's what we're looking at here. And we can see the various break-evens and things like that too. So if I hit create, and then now I have these trades created. Now, as everyone might know, or some people might know, some people might not know, the day after the earnings announcement, so on the 20th, Netflix pretty much rallied through the roof, and I think it went to about 585. So Netflix went from about 505, 501 in price to 585, which is well above and beyond my strike of 545 call that I'm using as my protection. So within just, a 12-hour period, we can see that my 122 expiration Iron Butterfly went from, a $2,500 credit to actually losing on the trade, of actually losing almost my max loss on the trade. Let me see if I can get this a little bit smaller. So, essentially my gain or loss the day after was $1,448. My max risk is $1,500. So just right on the open, I'm fairly right at my max loss of my trade because the stock went up above 545, almost to 585, and there is not much I can do. So this goes back to the question before is, what do you do at this point? So profitable wise, the vol crush, you really want the volatility crush to happen and get out of the trade the next day for the profit. The stock doesn't really move. In this case, the stock really had a big move, and now I'm right at my max loss. So in my mind, if I'm at my max loss on the 20th, which was Wednesday on the open, I still have all trading day Wednesday, Thursday, and Friday for this stock to potentially come back and maybe give me a little bit of a reprieve on my max loss. I can only lose another $52 if I stay in this trade. So my risk is, let's say, $52 more dollars, but my reward potentially is gaining this loss back and maybe even working into the trade for a profit if Netflix decides to come back down below 545 or below my break even, which is right around that 530 range or so. So that's my idea. I can only lose a certain amount, negligible in the whole scheme of things. So in this case, I would rather hold on to the trade until Friday and then just see if I can get some of this reprieve back. But to look at the two difference, you can see the 22nd, the options are expiring pretty quickly, 3 days. The other trade with 8 days on it, I still am at a loss, $1,100, but my max loss is, my max risk is about $1,300. So I'm still $200, to where the market can still move about $200 against me. But I have, that whole 3 days plus 5 more days for this trade to kind of work out in my favor and see if Netflix will potentially come back. So, that's why I think we can see the difference between, these two trades just on this 1 day's move. But if I move forward, let's say I move forward to the next day, we can see not much of a change. I'm still right here. Netflix stayed up, so I'm right near my max loss, 1493. But the 122 expiration or the 129 expiration, I'm pretty much almost at the same, maybe $30. I took $30 more of a loss, but I still have, roughly $180 to go before I hit my max loss, and I still have all that time. So if I go back to, 122, that's when this trade is going to expire on 122. We can see, I'm going to be 1453 is a little bit shy. Let me see, 122. But we could see that this trade is going to essentially, Netflix stayed up above 5. I think it stayed around the 565, 570 range. So, I'm taking a max loss on this 122 trade here. So come Monday, which is the 25th, that one trade is gone for a loss. But now the 129 expiration, as the stock is kind of settling down a little bit, possibly some of that volatility might be coming out from the weekend trade or from the weekend, days off. Now we went from being down 1140 or 1160. Now I'm down roughly $1,000 on the trade. So kind of getting a little bit of that money back. And then if I move all the way to, current day, which is close of business yesterday, I'm down, $1,100. So, and then if you look at the market today, Netflix is around 538. So the trade that, was $1,100 loser last night, I'm down maybe $600 on the trade as of right now. So I've gained another $500 back from this trade just by the stock being down. Now, the stock Netflix is down, let's see, it's down, 4.15% today. It's down $23 to 538. So that's probably not your standard move, but it can happen. And making some of this money back after you've taken, a big move to the upside or downside like that isn't always going to be the case. But again, I think, spreading that risk and saying, okay, my risk that I have remaining versus my potential profit that I have if things work out, the disparity is so big that it kind of leaves you for the option to make that adjustment. And typically it seems to be the more smarter adjustment to make. So, so this trade's still going on. I have my order essentially to get out, of my personal account. But what I did want to show you guys is, we've seen, if you look at the Netflix trade from what we've back tested with the vol crush, it was a 90% winner, meaning it has worked 90% of the time over the past 10 quarters. This is one time that it didn't work. And I'm glad that I have these 129 expirations in the account, because I think that showing these and having that extra time can only help you in a situation like this. Now, obviously, on earnings announcement day on 119, if the stock pretty much stayed right around that 105 or the 505 range, that 122 option expiration would make more money. The profit would be more because there's less time on the trade, and then you would be able to reprieve more of that volatility crush on those options. But with this trade, I believe you're still taking on a decent amount of risk, but in theory, I think your risk is a little bit lower because you do have more time. So there's always going to be a trade-off, your risk versus reward trade-off. But I think using the longer term options shows for a good example using this Netflix trade. So, I kind of jumped around a little bit using the virtual portfolio. You can't really see the graph of Netflix, but does anybody have any questions on what I showed and kind of how I went through it?
Sort of a question between a 1 week and 2 week kind of thing there.
Yeah.
If you're, I guess it depends on what day of the week you actually open the trade. If you have the 2 weeks out scenario, you're going for the expiration of the following week, but not the as is week, and the open price is approaching your short strike, but not there yet. I think the 2 week out, you have it. If it's a reversal, you get back into a winning scenario, and I think that's one thing you've demonstrated a few times. But if it just keeps moving slightly, farther away or outside of your short strike, your 2 week period is going to disintegrate faster than trying to get out if you had the 1 week expiration. You follow what I'm saying? It's like it's like the 2 week outs tend to hold your option values are held longer, right? Because you got a whole nother 5 days in
Right.
value in there. So it kind of you gotta I guess when you're managing the exit, you really got to watch. You got to pay attention to where how it's moving toward or through away and how fast it's moving in relation to your short strikes.
Right. Yeah, and that's fair. And I think one thing that we can look at, and somebody can chime in, but I feel too that on this example that I showed, it seemed like that weekend break. Obviously, you have 2 days of essentially decrease in value because the stock market's not moving and Netflix isn't really moving per se. But I'd have to look at the volatility, the implied volatility of those options. But I almost feel like after that initial jump up and then the market kind of runs sideways, you might get some of that volatility crush come then out of those options. So it might be a little delayed where you might not see that on those 122s because they are expiring that week. But once those 129s are now the up week ones or the next ones to expire, you might see some of that volatility crush come out because that trade has kind of settled down. The stock price has settled down a little bit. I can't say that that's a fact, but I feel like that kind of looked at some of those prices here. I'd have to look at it and track it day by day using like an implied volatility analysis on the options. But I feel like that seems like a fair theory.
Yeah, I
Does
would
that make
agree.
sense?
I feel that theory too.
I mean, I don't know if it makes enough of it doesn't make enough of an adjustment. I think if you're, if I'm losing $1,300 and I get a crush of 100, great. I just saved myself 100 off of 1,300. But still, I think at that point, any penny I can make or any dollar I can make back seems to kind of help me just a little bit more. But yeah, I mean, these are great trades. I think, my point is too that, some of these, like similar to what Bob mentioned on the bullish pre-runners, the market environment is definitely a little bit, uncertain right now. Fed meeting, all these different things that we have going on. Earnings are really good, I guess, for all these companies. Just all of a sudden, everybody's making money. There's nothing happening. So a lot of these earnings are good, but I still think that these vol crush trades, those bullish pre-runners trades, we've tested them and they're great. But, let it be known, we're going to have trades that aren't making money. I mean, that's just kind of the nature of trading. Everybody, I think, on this call understands that. But, you know, I wanted to show this example of, hey, this is a real one that, you know, I've taken a loss on. I'm sitting in this exact trade right now, and it's going to happen. I believe in that 90% win rate for Netflix. This is that one-off to where, you know, the stock jumped up and made a pretty big move, and I can't do much about it, but I'm going to move on and keep trading these things until they all prove me wrong, right? So it's hard, you know, it's not fun to lose money, no doubt about that. But, you know, I think everybody knows that that's kind of part of the investing game is being down money on some of the trades. But the best takeaway is using this Delphian tool, using this virtual portfolio to kind of understand what you're getting yourself into, understand the best way of possibly managing out of these trades as they do come about, and just understanding your risk and making sure that, you know, you're using this tool to the full advantage so you are prepared for when these things happen, you know, because they're going to happen. I mean, the losses are going to come on some of these trades, but managing out of them properly and managing out of them smart and intelligently is the key takeaway for me. And then using some of these strategies. You know, we've worked months together, all of us on this call. I feel we've worked months on working on these strategies, and we've come up with some really good ideas, you know, versus, you know, changing from that week's expiration to the next week's expiration for these vol crush trades. And I think it's just, you know, a drastic improvement, and, you know, I like it. So I appreciate you guys helping me do this stuff. And, you know, I'm learning a lot, and I hope you guys are doing the same, you know, because originally these were some trades from the meetup group in Tampa. You know, they were one day, you're in on a Thursday, you're out on the Friday, boom, see you later, and you're making tons of money. And as we know, that's not always the case. It's good to say that because it will help sell subscriptions, but that's not the real world, right? We know these trades are going to do like this Netflix. This is going to happen, but, you know, keep kind of spreading that risk, using those trades, using Delphian, and I think you're going to come out ahead. So questions, comments, anybody using this virtual portfolio at all?
This is John. Yeah, I use it all the time. I'm tracking everything, but for lack of time, I haven't caught up on all the trades.
Yeah, and I agree, John. Me too. I'm trying to track them all as well, all the earnings trades also, and I hear you. You know, I find it's definitely time consuming. So once I get a lot of this done, you know, you can connect with me, and I'll share a lot of that information with you. But yeah, I spoke to Josh this morning about that it is fairly time consuming for the morning and for the evening to get them set up. So
yeah, I'll be glad to do that.
Well, good. Yeah, I'm glad you're using it because I think, you know, obviously looking at how you're making money on a daily basis is good, but taking the strategies and going back in time and using the time machine to go back and try to track what you would have done, I think is key. You know, that helps you learn, and it helps you kind of live in the moment at that particular time. So it's a good tool to use, and I think it's great if you're not used to a certain strategy to try to figure out, okay, why are my break evens there, or why is my risk level here? You know, what are these numbers doing as I make these adjustments? And I think it can only help you if you have the time to do so.
Yeah, I use it to do my R&D.
Good. Yeah. Okay. Yeah. Perfect.
And Josh, Shawn, I would say that what you just said is it's really important, especially important when you're trying some of the other trade recommendations, the ones that come up with correlation to 1 year.
Yeah, the studies. Yeah.
Go back and analyze each one of those that you did, and I'll be a whole lot better trader. It'll build your confidence. Just going back day by day and looking and say, oh, here's why I did that this day. Here's why I did this day. I mean,
that's right.
That's invaluable.
Yeah,
right,
I learned what I did wrong.
Right. Yeah, I think it can help learn what you did wrong without putting your money at risk. You know, if you just do the trade in the virtual, it helps you. You know, I would hope it helps you learn, because again, the worst thing is to jump into a trade that you're not sure of, put your money at risk, lose some portion of that money, and really not know what happened. And because that's just going to make that next trade that much harder for you to execute, in my mind. You know, that's what it does for me. So I'm assuming it does it for a majority of other people as well. So to be able to go in there and say, okay, when this happens, this is what I would do. I would just get out of the trade. And then you can kind of analyze it a little bit further and say, okay, well, why was I thinking that way? Just because of, market movement intraday? Does that really make a big movement on the whole scheme of things if I'm in this trade for 20 trading days? And you can kind of make those comparisons and contrasts later.
I would look, at least look on your losing trades. Go back and analyze why you lost on a losing trade. That's probably more help than, okay, if I won and I was on the right trade, okay, I'll just do that again. But make sure you look at why you lost on a losing.
What I'm planning to do, I just don't have the time, but when I place a real trade, I also plan to put that in the virtual portfolio. And then I tend to close my real trades sooner because I don't want to hang out there for the risk. But then I always wonder, well, what it would have been if I held it for a day or two. So I'm going to start putting them in the virtual portfolio too, so I can go backwards and see if I did better by hanging on.
Right. And some of those two, what I would say is make sure if you're using a strategy that you can test within Delphian, test that strategy to see, instead of getting out at 25%, typically, would it give me a better win percentage or the same win percentage if I get out at 50%? Because sometimes going back in my mind and then looking at trades that, would have made more money, you just want to make sure you're looking at it subjectively and not just thinking that if you hold a day, no matter what, you're going to make more money, right? Just trying to figure out, try to put numbers like a back test to it to see, does Tesla usually keep running higher after earnings? And if it does, can I scalp more than 25% profit out of these options? Or is 25 just that perfect number? Maybe 100% is. But if you can test it, then I think that gives you a little bit of validity to it, because I had one in the virtual portfolio the other day, I think from a bullish pre-runner, and it was BBNY, which I think, or BBBY, which was Best Buy. And, those options went from like $100 a piece to like $1,000 a piece. And I was like, okay, well, that was a missed opportunity, but you just can't assume that every time BBBBY comes out as a bullish pre-runner, it's going to make that move. Now I can test it and say, does it typically move up 100%? And if it does in the testing, then maybe I could apply that to the next earnings. But, that one move that I missed, might just be that anomaly. We've talked about it before, using the scale out approach. If you can, buying more than one option and seeing if you can scale out of those options for, 25% and then scale out the next one for 100%, or however you want to use, that scale out approach. But obviously, if an option's cost $1,000 and your risk per trade is 1,000, you can't do a 2-lot. You can only do a 1-lot, and that's fair if that's still a trade that you want to do. But if you can do multiples, sometimes, testing it further in the system to see if you can try to get more money off that trade, those are going to be the ones that maybe if you do multiple lots, you can use a scale out approach for them. So, all right. Well, yeah, if no more questions or comments, we're trying to cut these down a little bit so we don't take up everybody's time, but we do appreciate it. I appreciate you guys listening to me. So any questions for me, again, as always, call me or shoot me an email. If we have questions on, using that scale out approach or, using Delphian to back test some of these ideas to see if we can gain more profit on some of these trades or maybe help minimize some of our risk on these trades, get in contact with me, get in contact with Josh, and we can kind of help you look at some of these different areas to see if we can, kind of optimize some of those strategies to help you based on your personal, your personal goals and things like that. So that's all I had.
All right, thanks, Shawn. Thank you all for attending. We'll put the replay up here shortly in case you missed sections of it. So we'll hang around for another minute or two if you guys have questions. But thank you all.